Hello again, everyone. It's Thursday, June 17th, 2021. I'm John Kosar from Asbury Research and Asbury Investment Management, and this is your Daily 5. These are my 5 most important charts and data series that I think are going to have the most influence through the end of this month and potentially as we go into the second half of the year. Number 1, market internals. The Asbury 6 remains positive. Those who know me from asburyresearch.com or from stock charts are probably familiar with the Asbury 6. The Asbury 6 is one of 2 quantitative in-house models that we have to tell us when to be risk on or risk off. That is, in the market, possibly adding risk or reducing risk, or maybe getting out of the market for a certain portion of your portfolio. So the Asbury 6 are 6 different metrics that we actually tested together to find 6 diverse ways to look at the condition of the market that aren't the same, that aren't going to just be one's a clone of the other one. They act independently of each other, and that gives us a better chance of not getting a false signal by any more than 1 or 2 of these. The only one that has to do with price, and we did this purposefully, is the monthly rate of change in the S&P 500. And the other 5 are market breadth or volume, corporate bond spreads, relative performance. The reason for this is the way the S&P 500 trades now, about 80% of the daily volume comes from algorithmic or computerized trading. There's a lot of day-to-day volatility. The S&P 500 could be up 40 during the day. It could be down 25 overnight, and then it could come right back the next day and be up another 40. So we're trying to look under the hood of the market with this metric to see what the real condition is and not to get hypnotized by the back and forth day-to-day movements we see in the S&P. So this particular model has been positive since May the 27th. When all 6 are positive, the market internals are the most conducive to adding risk to portfolios. That's where we are right now. It takes 4 in one direction to give us a signal. So in other words, to maintain a positive reading, at least 4 of these have to stay green. If 4 of these go red, that moves us to risk off. And now we're looking for spots to tighten stops, or maybe to take some of our risk out of portfolios. The second thing that we look at is, after we go to risk off, is where's support? Where's the tactical support level that we can attach to that current condition? And right now in the S&P 500, that's only 1% underneath the market at 41.77 to 41.68. I'm circling it with my mouse. That's the June 3rd low and the 50-day moving average. The 50-day moving average has been an amazing trend proxy since the beginning of the year. You can see it's been tested 5 times, starting on Jan 29. And I think the reason for that is because the buy the dip mentality is so strong right now. There's a lot of Fed stimulus. We're coming out of COVID. People are wanting to travel again and go out to eat again. People have checks from the government, stimulus checks to spend. There's a lot of catalysts for this, and clearly the 50-day has been the big level to watch. So here's how I look at this. If you're somebody who's just looking for risk reward, you're risking 1% here in order to potentially catch the next leg up in the stock market. And if we break 41.77 to 41.68 and the Asbury 6, which is updated daily, by the way, in Asbury Research's Research Center, this goes below that support and we move to a risk off on the A6, well, then you move that money out of the market and you start to play defense. So strictly from a risk reward standpoint, we're in a pretty good spot. However, there are 3 particular potholes here that I want to talk about. Follow the leaders semiconductors. We're going to look at semis first. Semis tend to lead tech. Tech tends to lead the broad market. So what we have here is SMH. It's the Van Eck Vector Semiconductor ETF. There's a number of these surrogates for semis or for the SOX index out there. This is the one we're looking at today. The reason I chose it is look how this ETF, which tracks the SOX index, the linear correlation to the SOX, is essentially lockstep. But it's been drifting sideways since February 16th. We tested it again on April 5th, failed. And so you've got this kind of triangular pattern that indicates investor indecision. We need to break out above 255.33, which was tested earlier this week, and we failed there. We need to break out above that, hold that breakout to let us know that this previous uptrend is resuming. As long as we stay inside here, we're not getting any leadership from semis, and that's a concern. The other part of this chart down here shows the relative performance of SMH versus SPY, which is the ETF for the S&P 500. And you could see that we've been in a 63-day or quarterly. That's our strategic time frame, by the way, is 63 days. So we've been in a quarterly or strategic trend of relative underperformance by SMH versus the S&P 500 since March the 4th. That's also being tested. So for me to feel more confident in being long here, I'd like to see 255.33 broken to the upside on strategic or quarterly relative outperformance by SMH. So that's one. Follow the leaders again. This time we're going to look at technology, and we're going to look at the NASDAQ Composite Index, the comp. It's the same chart, but now we're looking at the comp. You can see the February 16th high hasn't been broken since. And we tried at the end of April, failed. We've been drifting kind of back and forth through the 50-day moving average, which is the minor trend in many people's eyes. 14,175 is that level. That's the Feb 16th high. And meanwhile, comp has been underperforming SPY since February 25th. So this is another leader that hasn't been leading since February. But it is testing its 63-day or strategic trend. So what I would also need to feel more comfortable, like if we do rally from here, that it's going to have some legs, it's going to have some leadership. I want to see comp up above 14,175 and stay there on strategic outperformance versus SPY. If that does not happen in here or either in the semiconductors, the chances of the next rally in the S&P 500 having some staying power, it goes down a lot. Finally, follow the leaders in small cap. Here's IWM, which is the iShares Russell 2000 ETF. Look what we're doing here. Again, since February the 10th now, drifting sideways. There's no trend here, and that level that it needs to get through to indicate that the previous uptrend in IWM is resuming is 230.32. We're sitting there right on it. We made a couple of ill-fated attempts to get above it over the past week. And look what's going on here on a relative performance basis. Since March the 23rd, IWM has been underperforming SPY. So three traditional market leaders, semiconductors, technology, small cap, have all been underperforming the S&P 500 since February, March time period. That's why the S&P 500 has been able to stay up above the 50-day because of the strong buy the dip mentality of the market. But it hasn't been able to do anything with it because it's had a lack of leadership. So to sum everything up, from a risk reward standpoint, from a market internal standpoint, this is where the S&P 500 should start its next leg higher, but it's not getting any leadership. So those three areas I'm watching very closely, semis, tech, and small cap for leadership. The longer that they don't lead, the more likely we're going to roll into a correction to start the second half of this year. So there's your Daily 5. Thanks for watching, and we will see you at the next one.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.